Lots and lots of questions about tariffs. And I think part of what's really difficult is we don't have a lot of clarity on what the tariffs will be, and we don't know exactly who they're going to impact. But one thing that can be helpful is if we look at history of how did tariffs impact businesses last time around. And the great news is we had the same president, so it's easy to compare. If I think about businesses that you would guess would be really negatively impacted, I thought of a couple. One is a company called Carter's, and this is a company that makes mostly baby clothing, toddler clothing. Most of their production was happening in China. So as you would expect, their gross margins were negatively impacted going into 2017, 2018, and 2019, but minorly, right? Not as much as you would expect. Part of that is they were able to take price increases, and part of that was they were able to offset and move some of their production. And so their recent gross margins have actually been improved. They're actually higher than where they were before tariffs. For Dick's Sporting Goods, this is a sporting goods manufacturer. Again, a lot of the things that they sell are made in China. And you saw only a minor impact, really a negligible impact in their gross margins. And they were able to shift a lot of their supply around. And so now their margins are actually better than they were pre-tariffs. Mattel is the same story. More than 50–60% of their production was outside in China, and they were able to be adept at switching, moving their supply chain so that they were able to offset the impact of tariffs, and now their margins are quite good. This is all to say that most of the companies that we're talking about are thoughtful, they're able to adapt and shift their production. There may be small near-term impacts in terms of their overall profitability, but longer term, they're able to reallocate their capital, reallocate their supply chains so that they have the best efficiency and they're able to withstand the impact of tariffs. Now, that doesn't mean that everything's going to be fine, right? If I look at Carter's, for example, yes, their gross margins are better, but actually the stock price has declined materially because their business is weaker. So that's what actually really drives the stock market performance. It's not so much these exogenous events like tariffs. It's more, what is the competitive landscape? What are the fundamental drivers of the business? What's the health of it? That's what really drives the stock market performance. So I think it's really challenging when there's so many headlines and it feels like it should have an outsized impact on, how these companies are going to perform. But most of them are quite good capital allocators and they're able to shift and adapt. At the end of the day, the competitive landscape and the fundamental drivers of the business, that's what's going to determine the long-term stock performance. It's just hard to keep track of that when all the news headlines are so loud and noisy.